This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
I'm on to page 27. The audit process, fundamental concepts relating to an audit ethics, a healthy degree of professional scepticism, but I'm talking now, according to the article I read the other day, it's more than a healthy degree of professional scepticism. The audit profession is being called upon to increase the degree of professional scepticism that they bring to any audit assignment. It involves professional judgment. Where do you get professional judgment? From experience. Where do you get experience? By being an auditor for a long time, by being trained, by being educated, by continual professional development. So professional judgment is quite extensive in the world of accounting and auditing, to determine what is and what is not material, to determine what is and not in the public interest, to determine whether activities of a client may be described as questionable or creative or aggressive, or whether this is normal practice. There are limitations of an audit. What are the limitations of a statutory audit? It's historic. It doesn't project anything into the future. And that's another thing which I read recently, that there has been a call for auditors to report on the future reported prospects of a company. Now, how on earth an auditor can audit that, heaven only knows. You can't audit something which hasn't happened. By definition, an audit is something which is, you're auditing transactions and occurrences and incidents which have happened in the past. You can't audit something into the future. You can do work on projections in order to determine whether the projections appear to be reasonably prepared according to the assumptions stated, but you can't audit them. Sufficiency of audit evidence is another fundamental concept. Audit risk. Define audit risk. Now, when you did F8, audit risk would be defined as a combination, or a product of three elements. But now you're at P7, it's been reallocated, and it's now a product of only two elements. The audit risk is now, and we'll come to it, but audit risk is now the product, the multiplication of a risk of material misstatement multiplied by detection risk. Historically, until within the last 12 months, it was inherent risk multiplied by control risk multiplied by detection risk. But those first two, inherent risk and control risk, have been combined to make risk of material misstatement. And the responsibilities of management is also a fundamental concept related to audit. The responsibilities of management and the repeated identification of those responsibilities in every opportunity, in the discussions, in the engagement letter, in the management letter, the weakness letter, in the audit report, in the director's report. Every opportunity we get, we repeat to management, it's your responsibility to look after the accounting records, to prepare the financial statements. It's your job, not ours. Planning. The primary objective of audit planning is to reduce audit risk. Audit risk is this combination of risk of material misstatement and detection risk. Risk of material misstatement is a combination of inherent and control risk. The planning exercise is designed to try to quantify the risk of material misstatement. So quantify inherent risk, quantify control risk, multiply the two together. That gives us risk of material misstatement. If the risk of material misstatement is high, then the auditor has got to fix detection risk at low. There is a very low chance that we will miss a material misstatement. So that necessarily will involve an extension of the scope of the work which we carry out. And if we're going to extend the scope, we do that by reducing the materiality level so that more transactions and more balances are brought into above the threshold of materiality. So that will automatically extend the scope of our work. And instead, therefore, of checking 70% by value of inventory, by reducing the materiality level, we will automatically check greater than 70% of inventory. We'll increase it to 80 or 90% of inventory. Same with receivables and payables. So the purpose of audit planning is to reduce audit risk, the risk of the auditor reaching and issuing an inappropriate audit opinion. An inappropriate audit opinion is typically where an auditor signs an unqualified, unmodified opinion. We are of the opinion that the accounts due to the financial statements do show a true and fair view. But history then, or the future then, shows that historically that was an inappropriate opinion and it should have been qualified or modified in some way. So that would be an inappropriate opinion typically. But I suppose it's potentially available to say that an inappropriate opinion is where the auditor gives a dirty, qualified, modified opinion, and in fact it should have been a clean opinion. I can't think of an example when that has happened, but that would be an illustration of an inappropriate audit opinion. The normal one is where an unqualified opinion is given and it now transpires that it should have been qualified. Planning entails developing general strategy and detailed approach for the nature, timing and extent of the audit. How are we going to do the audit? And it involves an assessment of the client's internal controls and accounting controls. Because if the internal controls are poor or weak or not auditable, there's no visible proof that the controls have been exercised, then there's no point in carrying out any control tests. Because if the controls are not reliable, why waste time doing control tests? And so an auditor will switch immediately to doing substantive testing. It will be a substantive test-based audit. But if the controls are potentially strong and are auditable, then we will test the controls in order to justify increasing materiality level, therefore decreasing the scope, and still reaching an acceptable audit opinion based on the work we've carried out. The objectives of planning are to ensure proper attention is devoted to different areas of the audit, those areas of the audit which represent greatest risk. I taught an internal auditor course 5-6 years ago, and the Chamber of Internal Auditors repeatedly said in the material I used to prepare the course, repeatedly said that there's only one way to do an audit. There's only one way, and that's risk-based. So you identify potential risk areas and you target and focus your attention on those risk areas. And any area which is perceived as carrying little or no risk, ignore it. So you target and you focus on those risks in order to determine that the risks have not happened, have not occurred, and therefore overall we can reach a true and fair opinion, a clean true and fair opinion. So ensure appropriate attention is devoted to the different areas of the audit. Ensure that potential problems are identified. This is risk identification. And also it will facilitate review. Facilitate means to make easier. To facilitate means to make easier. We should consider materiality and its relationship with audit risk during the planning phase. It will assist with meeting the first two objectives, focusing attention and ensure that all potential problems are identified. It will focus attention. Then we have a new idea, relatively new. 5 years ago, the threshold of significance was introduced. The new standard, I really ought to cross out the word new now because it's no longer new. The new standard requires auditors to establish a threshold of significance, and this will be applied where a control is designed, implemented or operated in such a way that it's unable to prevent or detect misstatements on a timely basis. If it is potentially the case that an error occurs and it's not reported on a timely basis, then we have this threshold of significance concept. And the control, such a control, as necessary to detect misstatements, is missing. We need to ask, are the identified deficiencies, either individually or collectively, are they significant? And significant deficiencies will be communicated to those charged with governance, typically the Audit Committee, and insignificant deficiencies will be communicated to management rather than to the Audit Committee. So it will be communicated to the board, but we think they're not significant. But if we accumulate either individual or significantly identification of deficiencies, and they are significant, then we should report that to the Audit Committee, the non-exec directors, and they will take action. They will then approach the board and say, what are we doing about these significant deficiencies? Materiality is not defined. We can talk about it, and we can give it a quasi-definition. The Americans have got a book explaining what they consider to be material in the context of financial statements. Their book is 365 pages long. The UK equivalent is 365 lines long. And it finishes with the earth-shattering conclusion that says, it can be seen, therefore, that an item is material if it is significant or major. And then I feel that it should say in brackets, or material. It's material if it's material. Now we can give it a quasi-definition. An item is material where its inclusion or omission would likely affect the view of the financial statements in the mind of an informed reader. So if we include it, if it's not included and it were to be included, it would change the view of the financial statements in the mind of a user of those financial statements. Whoa, if I had known about that, I wouldn't have relied on these statements. It's concerned not just with size or value, but also with the nature. Quantitative significance is where the numbers are wrong. Qualitative significance, or qualitative, I always struggle with that word, qualitative materiality is where the numbers are basically right, but for instance a disclosure is not totally clear. An item, the explanation of an item within the accounts is not absolutely clear, unambiguous, brings the correct impression to the minds of a reader. So you can have qualitative materiality where even though the figure itself is not material, the words which explain the figure are tricky or ambiguous or potentially misleading. I use as an example when I'm talking in F4, I use as an example and say when I first came out here, I would go out drinking every night. I would drink your local beer, heaven forbid I used to do that. I would drink your local beer, maybe 8 or 9 drinks every night, but I'm happy to say that I don't drink anymore. I don't drink any less, I just don't drink anymore. So you see the use of the clever use of the English and the ambiguous way in which it can be expressed can give a completely wrong impression. If I say I don't drink anymore, you think I'm no longer an alcoholic. But if I don't drink anymore, it says my limit is now 9, I don't drink 10. So it can be misleading, and your use and choice of words can mislead. I don't actually, I hardly drink anything these days, and just coffee and water and the occasional half a mouthful of beer. Judgment about material are made in the light of surrounding circumstances and affected by the size and nature of the misstatement or combination, and the likelihood about its chances of recurrence. Judgment about matters that are material to users of the financial statements are based on consideration of the common financial information needs of the users. Do we feel that the users should be given any more information? A past exam question, a long time ago, a past exam question. More information leads to better decisions. Discuss. That's the first time I've ever asked a group of women to discuss anything and they're totally silent. More information leads to better decisions. Discuss. The printed solution, the examiner's answer, said quite clearly this is the case, this is true, because the more information which is given to the decision makers, then they are better informed, and if they're better informed, then the decision that they arrive at will be a more justifiable, and more sensible, and more rational, and more logical decision. And I query that, and I query it on a number of grounds. For instance, if I've got enough, sufficient information, do I really need the availability of a library full of books about information related to the same subject? Is that going to make a better decision, or am I going to be overwhelmed? It also is questionable on the grounds of more information. The more information has to be relevant. I could give you all sorts of information about the weather, about the cricket scores, about how England drew the series with New Zealand, with 3 consecutive drawn games. I could give you all sorts of information, which is irrelevant to the matter at hand. So you have to qualify and say more relevant information may lead to better decisions. But here's another point. If our decision makers are already making optimal decisions, how can you have better decisions by giving them more information? In fact, more information could lead to worse decisions because you overwhelm the decision makers, you overpower them with all this information, pile it on and on and on, and eventually they lose interest and maybe oh, I'm fed up, I'll just make this decision. And so you could find that a surplus of information could lead to non-optimal decisions. But the examiner's answer quite clearly said, this is obviously true. And it isn't obviously true at all. And a discussion, therefore, has to take in both elements, both the arguments in favour and the arguments against. But the examiner's answer only said, basically, yes, quite clearly this is true. More information does lead to better decisions. And it's too simplistic. It was too simplistic an answer, in my view. But who am I? I'm not the examiner. What do I know? The audit firm must be concerned with identifying material errors, inclusions, omissions and misstatements. Material, define material. They can't. It's just, in the auditor's subjective assessment, what is likely to change the mind of a reader? If I omit that information, is that going to change the mind of a reader? If I include that information, is it material? Is it likely to change the view of the financial statements in the mind of an informed reader? And now bottom half of page 28, a new idea, performance materiality. We set the materiality for the financial statements as a whole and quantify it. Here's another thing which intrigues me. I'm absolutely staggered by this. How many materiality figures, amounts, do you use in the conduct of an audit? Presume one. You say, this is the figure which is material. You arrive at that figure on a number of different ways, but it's just one. Agreed? You don't take it as a percentage of revenue and percentage of profit and percentage of assets. You just have one figure. You don't have 3 materiality levels. In the UK, we used to have 3. Does it affect the income statement? Yes. Does it affect the revenue? Yes. What's the percentage of revenue which is material? Therefore, we'll check it. Does it affect the profit figure? Yes. In a material way, what's the percentage of profit? If it's greater than the materiality level, we'll check it. Is it greater than a percentage of assets? Yes, then we'll check it. We had 3 separate ones. You have 1. And I don't see how it works. Because something which is immaterial in the context of revenue may be material in the context of profit figure. If it's 10,000, if your revenue is 3 million, and you've got a 10,000 materiality level, it's immaterial in the context of revenue, but it could be, if you've only got 50,000 profit, that 10,000 is material.
Yeah, but you never set the materiality like this, just let's take from revenue. You always think, which is the key business driver. If the profit is key business driver, you take the profit. It's not necessarily you take the...
But it's still only one figure.
Yes.
So you don't then apply that figure to revenue, or you don't then say that figure as a percentage of assets is.
No, you can take the percentage from assets, yeah, if you want.
But it might be immaterial in the context of assets.
If you take from profit?
I think if you're only going to take one base figure, I can understand you only taking profit as your base figure. I can understand that. But surely something may be material in the context of revenues or material in the context of assets, which isn't material in the context of the profit figure. If you've only got few assets and you operating lease the assets rather than finance lease them, then a figure which is not material for the profit could be material in the context of assets. It could be that one of your operating leases is a finance lease, but that change is not going to affect your profits, but it has a material effect on assets.
Think what is important for the Vita.
So in fact, you have to think what's important for the... So in fact, you don't just take one figure. You don't just take the one quantified amount and apply it broad brush across everything. You think, what is that amount in the context of assets? What is that amount in the... So, but we used to have three. We used to have three materiality bits, and then determine whether it was a revenue affecting, whether it was profit affecting, or whether it was asset affecting, and we would apply it appropriately, or apply the three different ones appropriately. But here we are on performance materiality. We've set materiality for the financial statements as a whole, but set an amount less than this when designing the nature, timing, or extent of audit procedures. So if your materiality level for the financial statements is, say, 50,000, then you may set as performance materiality, you may set a figure of, say, 10,000. So with individual account balances and classes of transaction, you're looking at a materiality level substantially lower than the overall materiality level. And this lower value is to be used when considering classes of transactions, account balances and disclosures. It's set at planning stage, and it will always be a matter of professional judgment. The person responsible for planning, the audit senior in charge, will design the audit plan, submit it to the manager for review, maybe submit it to the partner for review, but it will be the audit senior who prepares the plan and therefore sets the materiality levels. I would not be surprised if materiality levels 1 year after the next were the same level. I would not be surprised at that, because when you're budgeting, it's easy to budget based on last year. And the same with planning for audits. But we often use a percentage of turnover, or a percentage of net assets, or a percentage of net profit, and decide whether or not it's material in the context of each or any of those. Using a benchmark approach, we should consider the elements and whether there are matters upon which users are likely to focus, and the nature of the entity, its life cycles, the industry, the economic environment, whether the banking industry in your particular country is reliable or whether there's an element of doubt, whether you can rely on the accounts of Cypriot banks or Cypriot disclosures of revenues received, because I imagine there's a lot of cash transactions going on in Cyprus at the moment, because you can't get more than €100 out of the bank on any one day. So people will be reverting to doing cash transactions. But cash transactions are easier to hide, if you don't record them, than a credit transaction. So I imagine that there could very well be questionable sets of financial statements in Cyprus in the next 12 months where in fact not all revenue was disclosed. I could see that happening. We need to consider the ownership structure and the way the entity is financed. The relative volatility of the benchmark figure that we've established. Levels chosen for materiality and for performance materiality depend on the confidence that the auditor has in the client's figures, and you could include there the confidence that the auditor has in the client's integrity. And therefore level of risk attaching to the client influences these levels. Materiality impacts us in a number of ways. It affects the scope of the work that we're going to carry out. It affects the nature of the audit tests that we're going to conduct. It affects whether we're going to ask the management to put through any adjustments for any mistakes or errors that we discover. And it affects the degree of the audit modification, the audit qualification. It may be we disagree, but we only disagree on a material level, but only with reference to one section of the accounts. Or it may be that we disagree with reference to a number of elements of the financial statements, in which case it will be a pervasive disagreement. It will be very material. Risk assessment and internal controls. We need to, here we go again, we need to obtain an understanding of the accounting and internal control systems sufficient to plan the audit and develop an effective audit approach. We need to use professional judgment to assess audit risk and design audit procedures in order to minimize that risk. Audit risk is the ultimate risk. The opinion is inappropriate after completion of all audit procedures. Made up of two component parts, and there are three listed. It's made up of two component parts, but the first two, there is an and there. Control risk and detection risk. A material misstatement risk is the combination of inherent and control. That could be better worded, I think. It's made up of two elements, risk of material misstatement and detection risk. Risk of material misstatement is made up of control and inherent. Inherent risk, the susceptibility of an account balance or class of transactions to material misstatement, either individually or in aggregate, assuming there were no related internal controls. Inherent risk arises because of the nature of the business, the location of the activities, the desirability of the products, the integrity of management, the experience of management in the field that they're now operating. This is all to be fitted into example 1. Suggests circumstances or factors that would cause you to believe that the level of inherent risk attaching to your client was higher than usual. New field of business, new management, inexperienced management, a history of failure to comply, new markets, decided to open a manufacturing base in Burkina Faso. How secure are our assets, or are they going to be sequestered by the national government? That happened in Bolivia recently. The Bolivian government told a Spanish petroleum company, Repsol, that Repsol were not putting enough back into the Bolivian infrastructure, and as a result they were going to take the Repsol assets and seize them, sequester those assets, and prevent Repsol from gaining access to those assets. So, is there a risk that the national government of the country in which we're operating is possibly going to seize our assets? Or is it a stable government? Where did I hear stability recently on the radio? This morning, a member of Parliament of Cyprus said that by their interim measures they were hoping to achieve stability, and that they were looking within 6 to 10 weeks of getting back to, inverted commas, a normal state. Well, we'll see, won't we? 8 to 10 weeks is about the date of your exam, isn't it? Your exam is about 10 weeks. It's that first week of June, isn't it? So that's the whole of April, the whole of May. That's 9 weeks-ish. Yeah. And then a week in May, that's 10 weeks. Oh, plenty of time. Oh. It's the new products, new management, new area of operations, new law, questionable activities, antisocial activities, inherent risk. Dealing in transactions on a cash basis creates an inherent risk of under-declaration of revenue. The desirability of your inventory is an inherent risk. If your employer is in the nuclear fuel industry, I don't think there's any temptation of an employee to steal the nuclear rods, is there? The nuclear fusion rods. I don't think there's anyone going to take any of those home. Unless it were Homer Simpson. So the desirability of inventory is an inherent risk. Control risk. The risk that the company's accounting and internal control procedures fail to detect or prevent fraud or error on a timely basis. We should make a preliminary assessment of control risk and should plan and perform tests of control to support the assessment. This is at the planning stage. How in practice do you go about assessing the quality of the controls claimed to be in operation at the client? What's the first thing you'll do? What's the first thing you'll do?
Know the controls?
In trying to assess control risk. What's the first thing you'll do?
Know the control and
Understand the process. How are you going to understand the process? You're sitting there now. How do you understand the process of a client? This is the first time you've been on the job. How are you going to understand the process?
Ask.
Yeah, ask. But before that, before you even ask, there's something else that you would do. And it's a common feature within F8, and I don't see any reason why it shouldn't be in P7 as well. Look at last year's file. That's what you do. Look at last year's file. Look to see the control risk assessment last year. Look particularly at your letter of recommendation, your weakness letter that you wrote last year and that you wrote, or that was written, not you, that was written this year, recommending changes to the control systems. Look at last year's file and determine whether or not, and then ask, did you change your systems in accordance with our recommendation that we made at the interim audit? Have you changed your systems? With effect from what date did you change your system? Because when you go on the interim audit in September to do interim work on the first 8 months, then you'll write your letter of recommendation. So that first 8 months have been working on the old system, and then only when you make your letter of recommendation will it change. So you actually got a 2-period year. You got the first 8 months before the change and the last 4 months after the change. And then at the end of the final audit, in March, in April, you write them a letter. And hopefully they will implement your recommendations at that stage. So the year splits down into distinct areas, depending upon the date of your letter of recommendation or your weakness letter. And you need to determine from last year's file what weaknesses did exist, have those weaknesses been identified, and have they been addressed by letter of recommendation, and have the directors implemented the change? And if they haven't, why not? Because you talked through this with the audit committee. This was discussed with the audit committee, and the audit committee will have supported you, and the internal auditors will have supported you. Why has management not insisted on a change? Why have the internal auditors not adopted your recommendations and implemented the change with management's permission? Why has that not happened? Because if it hasn't, the weakness still exists. The control risk is still there. So we make a preliminary assessment of control risk and plan and perform tests of control to support that assessment. If it's a new client, if it's the first time your firm has audited this client, quite clearly you can't look at last year's file. So one of the things you'd have to do is sit down with management. This is your first year audit. You have to sit down with management and identify how the control system is scheduled to operate. You can write it out in longhand, you can type it on your computer, you can draw it in a flow chart, you can fill in an internal control questionnaire. One way or another, you have to get the information as to how the control system operates. But that flow chart, written notes, internal control questionnaire should be updated every year, and it's part of the interim audit process. Has this changed? This is recommended, it should change last year. Has it changed? And if so, how has it changed? And does this new improved system fully address the control weakness which we identified last year? These are preliminary steps. This is what should happen with any reputable audit firm. Detection risk. This is the risk that the auditor's substantive procedures fail to detect material misstatement. It shouldn't happen. It should not happen that the auditors fail to detect material misstatement. I'll give you one exception when it's agreed that it can happen. But the auditors are required to plan the audit in such a way that they have, what's the expression that I've said 6 times already today? You should plan the audit assignment in such a way that you have a reasonable expectation that you will discover any material misstatement, whether arising through fraud, error, or other irregularity. Fraud, error, because material misstatement includes omissions, doesn't it? That you have a reasonable expectation of discovering any material misstatement, whether it arises through fraud, error, or other irregularity. Now let me extend that, because if you plan an audit, complete the audit, give an inappropriate audit opinion, that's almost conclusive proof that you failed to plan the audit properly. You failed adequately to plan the audit. Because if a material misstatement exists and you didn't discover it, then you didn't plan it properly. The exception to that is where the error or omission or fraud or misstatement has arisen as a result of collusion at the highest level, at management level, where directors collude to mislead the auditors. Then, do you know the word collude? Collude. Combine, join together to devise a scheme in order specifically to mislead. So collusion is the coming together of 2 fraudulent minds. 2 or more. And if there's collusion at the highest level, then the auditor can be forgiven for failing to discover material misstatement. Yet the audit manager for Vortex, an entity involved in the manufacture and sale of clothing for teenagers, half of its sales are on credit to a variety of outlets, the other half are through its own chain of shops. Staff are chosen for their youth, enthusiasm and knowledge of the fashion scene. Can you identify the inherent risks that may arise, and can you suggest appropriate controls to reduce the impact of these risks? I'm going to miss that off. I'm going to ask you to do that tonight. This evening, I don't ask a lot of you, but can you fill in example 2 on page 30? The answer to example 2 on page 30. Is it worthwhile me asking you to do this? Do you have alternative things to do which are more interesting? Like watching the snow melt? Counting the icebergs as they float past on the river? Page 31, planning materiality and assessing risk of misstatement. Involves determining the level of risk attaching to different areas of client operations. The chance of detecting errors is increased and excessive time isn't wasted on low-risk areas. Some audit firms concentrate on understanding management's control of business risk and their overall control of the information systems. Business risk, then, is only the second time today I've mentioned it. I did identify that your examiner could ask you about risks in 3 different ways. Audit risk, financial statement risk, and business risk. And the question I looked at this morning briefly with you to show you an example of a P7 question, the question medics within the Kaplan revision kit, asked you to identify business risks. In my view, and I'm not doing the exam, but I'm maybe can help you. In my view, it seems to me that a business risk question, your examiner has to give you enough detail that the business risks actually jump out of the paper at you. she'll say things like, the client is in the closing stages of developing a new drug, but they've just heard that an opposition, a competitor, is developing a similar drug and is about to market it next week cheaper. And so one of the business risks is that this new drug that your client is developing is not going to have the sales which are anticipated. So it's a bit, and if you don't have the sales and you're dependent on that drug, then you're facing potentially going concern problems. A business risk that you may be operating under a franchise, but the franchise is reviewed every 3 years and you may lose the franchise depending on your performance. If your performance is not up to standard, then the franchise could be taken from you. And then that leads on to, if we don't achieve the right standards of performance, and we know therefore the franchise will be taken from us, will there not be a temptation for the figures to be manipulated in order that we do reach the acceptable level of performance? And that then gives rise to financial statement risk, because the figures are open to manipulation, creativity. So in a business risk question, the risks effectively jump out of the page. She has to give you the information effectively, word for word within the question. Now, I find that type of question relatively straightforward, relatively easy. I'm hoping that a business risk question comes up, because the answer's there. Identify and explain the business risks. 2 questions. Identify and explain why it's a risk, or the impact of the risk. Business risk can be split into 3, financial, operational and compliance. And there are examples of all 3 there. These are financial risks arising from the company's financial activities or the financial consequences of operations. And examples include going concern, overtrading, credit risk, inherent risk, high cost of capital. I'm thinking Greece here. I'm thinking the country, Greece. Going concern problems. I'm not going to say that Greece is going to sink into the Mediterranean, but quite clearly there are going concern problems hitting all of these PIGS countries. Who are the PIGS countries? Portugal, Italy, Ireland, Greece, Spain. It's an acronym. It's PIGS with 2 eyes. Well, pigs do have 2 eyes, don't they? Yeah. So, and now Cyprus, and possibly Slovenia. I'm sorry, Slovenia. I'm sorry that I've raised the question of doubt in the minds of those affected that Slovenia is a going concern, but it may not be. It's a Euro domino effect. Overtrading. What's overtrading? Stretching yourself beyond your working capital abilities. Credit risk. Interest risk. It's out of your control. Credit risk, you can't get the credit. You can't roll over your bank loan. You can't borrow money at a sensible interest rate. Greece is borrowing at 7%, and 7% is identified as the break point. You're unviable. You're not a viable entity if you're borrowing at greater than 7%. High cost of capital. And unrecorded liabilities, where obligations, liabilities do exist and they're unrecorded, and then that gives rise to financial risk, because these unrecorded liabilities are suddenly going to ask you for their money. Operational risk, these are the ones arising from the operations of the business. Poor stock control giving rise to stockouts. Physical and stockouts give rise to lost custom, and lost custom gives rise to lost loyalty, and lost loyalty means your competitors gain your customers, and you lose your market share, and you lose your market share so you can't finance your borrowings, and you can't finance your borrowings so your creditors call in the debt, and suddenly you're facing going concern problems just because you didn't have a sensible stock control system. Physical disasters, can't help those. Physical disasters, I was going to suggest breakdown of machinery, but we should have operational controls to prevent and minimize the chance of machinery breakdown. But physical disasters like Your suppliers are unable to deliver because their delivery wagon has broken down. So you can't get your inventory in time, so you lose your customers, which leads to blah, 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 liquidation. Loss of key staff. The training establishment I worked with in the UK had one of their key players, one of their key personnel, stolen from them by the opposition, who offered him a portion, performance bonuses and super improved salaries and lots of benefits. And key personnel are available to be stolen by your opposition or even by clients, auditors, even by clients. And you lose your key staff, and that causes operation problems because it puts greater, greater responsibility on other people still within the organisation. Loss of key staff is a problem. Poor brand management. We bought a brand, and yet we're not looking after it, and we're not promoting it, we're not advertising it, and marketing it. And that operational risk could then give rise to us losing custom. And loss of orders. Why? Because we've developed a reputation for being last minute. Yeah, we'll process the order, but we'll not do it yet. When do you want it? Tomorrow, plenty of time. So loss of orders could give rise to a loss of efficiency, could give rise to losing orders. Or if we send the wrong orders, or send the wrong quantity, or we deliver washing machines and they wanted dryers, you lose your reputation, you lose your custom. Lose your custom, you're heading to liquidation. A compliance risk, the third element of business risk, the breach of listing rules. If you're a listed company and you break the stock exchange rules, breach of statutory requirements, you're failing to comply with statute. Litigation risk, you've entered into transactions which are contrary to the law, or you've sold a product and you're now being sued. And potential is, or even if you are suing, there is a potential that you will lose. And if you lose a legal action, that's expensive. You've got legal costs, court costs, and the costs of the opposition's defence. Even though you think you're right, it can be very expensive to indulge in legal activity, litigation activity. It can be very expensive. You've got to be pretty certain you're going to win before you take it on. VAT problems, that was the case I just mentioned to you after break, where I've read about this gang of 5 people who claimed to have made a film, and in fact, and therefore cheated the VAT man. Tax penalties and health and safety risks. Management need to satisfy themselves that systems of risk management and internal control are working properly. Look in the DEVRO accounts. They're satisfied, they've identified the risk, and they've identified the consequences of the risk and how they're addressing those risks, how they're managing them. Analytical procedures, page 32. Only after I'd qualified, you come to the recognition that some bits of auditing are rather more critical, important, material than other elements of auditing. And I came to the conclusion in my own mind that analytical procedures is probably the strongest weapon that an auditor has within the arsenal that the auditor possesses. Analytical procedures is one of the strongest elements that an auditor can use. I've no doubt you auditors in the room, you rely heavily upon analytical procedures at the planning stage. Yes, you do. Get the draft financial statements and you analytically analyse them to determine which are the risk areas. Where figures have changed, where that change was not in the line of expectation. But equally, and this is very clever, where figures haven't changed, but you would have expected them to. And analytical procedures is a strong element within the auditor's armoury, within the auditor's arsenal. Analytical procedures include the following types. They include, it's not comprehensive, analysing this year's draft figures with prior periods, or analysing this year's final figures with prior periods, comparing them with budgets, forecasts, predictive estimates, industry information, competitors, it doesn't say there, but comparing them with competitors, Comparing them within the financial statements, the interrelationship of figures within the financial statements. If I tell you that motor vehicles in this year's draft financial statements are 200,000, and motor vehicles in last year's financial statements were 60,000, what else would you expect to change? Last year it was 60, and will have been depreciated by another year, down to maybe 45. This year we're looking at 200,000. What else would you expect to have changed?
Invoices. Buy new cars.
Yes, you would want to inspect, as an audit procedure, you would want to inspect the invoices or the finance leases under which the new cars have been acquired. But that's not what I'm asking. What I'm asking, what other figures within the financial statements would move in line, or expectation would move in line with this increase in motor vehicles?
Maybe payables would increase if it's not.
Maybe payables, if we've not paid for these motor vehicles yet. Something rather more, expenses. Think about expenses.
Increase in depreciation.
Yes, there should be an increase in the depreciation figure. What about motor running expenses? Fuel costs. Who's driving these cars? Somebody's got to be driving them. Who's driving them? There's a limit to the number of cars that your boss can drive. He can only drive one at a time. So who's driving these cars? Which employees, and why did they not have a car before? So presumably new employees. So you'd expect an increase in the number of employees, possibly at higher levels, so we're getting a number of new managers coming in, wanting cars, or possibly salesmen. Possibly you increase your sales staff. And if you've increased your sales staff, would you not expect revenue to increase, and our production levels to increase, and therefore cost of sales to increase? They would also should have increased, shouldn't they? Am I wrong? I am wrong. No, I'm not wrong. I think I'm right. Okay. So other figures within the financial statements, finance lease interest, would appear, or would have increased. So you accept that there is an interrelationship of the figures with it. It fits together like a jigsaw. It fits together nicely. The financial statements do make sense. But I'm now telling you that the only figure that has changed, in all of those, the only figure that has changed is finance lease creditors and motor vehicles. There's no increase in staff costs. There's no increase in motor running expenses. There's no increase in depreciation. There's no increase in repairs. There's no increase in production. How can that happen? Because our auditors here are going to look and say 200 compared with 60. Whoa, I'm expecting other figures to change, but they haven't changed. Now, how could that happen? Me as the director of your client company, you're going to come to me and say, Mike, these 60,000 cars, which should be written down to 45, now appear as 200, but nothing else has changed. How can that happen?
Something is wrong.
Something's wrong. No, absolutely nothing wrong at all. But that's the beauty of analytical review. Analytical review doesn't answer questions, it raises questions. So the inquiring mind of the auditor is going to say, oh, I need to ask some questions about this. So you come and ask me a question, say, Mike, it's gone from apparent 60 down to 45, it's gone to 200, but nothing else has changed apart from finance lease creditors. Yes, I say, because we bought 8 cars, we signed finance leases on the 30th of December, 2 days before the year end. So of course the vehicle will increase, the finance lease will increase, but we've not yet employed the staff, so the sales have not risen, and there's no depreciation because it's only 2 days, and there's no motor running costs because we've not actually received delivery of the cars. They're still at the cars, they're still at VW, so nothing else has changed, but everything is right. And that's a beautiful thing about analytical review, that simply by looking at the figures and smelling the figures, do the financial statements, do they smell right, or do they stink? And that's the clever auditor that can do that. Analytical procedures, wonderful. It's a wonderful tool for the auditor. When does it come in? When do we apply analytical procedures? Well, I said that our auditors here, they will have looked at the draft financial statements at the planning stage in order to identify which areas need focused attention. So analytical procedures take place at planning stage. But they also take place through the course of the audit. It's an ongoing thing that as mistakes are found, for instance, and you discover that in fact we didn't sign the finance leases on the 30th of December, we signed them on the 1st of January, in which case that's kind of a material effect. Cars go down, finance lease creditors goes down. So analytical procedures, so we bring the cars back down, we get rid of the 8 cars that we just brought on finance lease. Now let's reanalyse and see whether the figure this year, 60,000, is comparable with last year's figure, 60,000. And the answer is no, it's not. Because last year's 60,000 will have been depreciated and it's still at 60,000. It's wonderful. Do you feel, oh, what a thrill. What a thrill you get when you perform analytical procedures. So it's an ongoing thing through the audit. But of course it's also analytical procedures conducted at the end of the audit, at the review stage. Because your senior or the manager, the assistant manager, the partner, they're going to look analytically at the figures, inverted commas, the final figures which have been produced. They're going to look at those final figures to determine whether or not analytically these figures make sense. So it's an ongoing throughout the course of the audit, beginning, middle and end of the audit, you're going to have these analytical procedures carried on. When intending to apply analytical review as a substantive procedure, the auditor needs to consider the following: the objectives of the review, the nature of the information, the degree to which it can be subdivided, and comparability, availability, reliability and source of information. There's no point analytically reviewing information which is unreliable. And the source of that information, is it a reliable source? When you're gathering together sufficient appropriate audit evidence, the appropriate audit evidence is dependent upon relevance and reliability. And the more reliable it is, then the more confident you are in using it in your analytical procedures. We should apply analytical procedures at or near the end of the audit to determine whether or not the financial statements are consistent with your knowledge of the company's business. And when they are, and when they do identify significant fluctuations or relationships which are inconsistent, then we ignore the analytical procedures. When we're carrying out an analytical review, and the analytical review results or gives us a picture which is inconsistent with the rest of the audit evidence, then we can just ignore the analytical procedures. No. Can I not? You're absolutely right, I can't. If any piece of audit evidence is inconsistent with the rest of the audit evidence about that particular matter, the whole lot is then questioned. It's questionable. So I've built up a picture, I've got the evidence and building up evidence about receivables. My analytical review says, oh, it should be a lot less, but it's actually gone up. Then all the evidence I've collected is now, it's like a house of cards. It falls down and I have to start rebuilding it. Because the analytical review, the result of the analytical review tells me that the receivables should have gone down. But the receivables have in fact gone up. So it calls into doubt all the evidence that you have so far collected. And effectively, you've got to start again, building up this wall of evidence. Life's a bummer.